From New York City for our viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, the U.S. economy signaling strength with reports showing relatively tame consumer inflation and stronger than expected job growth. Traders are now repricing bets on rate cuts, sending the two-year yield lower. And the spending spree to fuel the AI race is disrupting everything from public to private debt. We begin with the big issue, a mixed economic landscape.
I think this morning's inflation print was actually pretty encouraging under the surface.
The larger picture is still a positive picture.
The economy still looks pretty solid.
The economy is fundamentally healthy, and I think it is going to accelerate it.
The narrowness of growth in the economy has always been an issue.
The bigger issues are the macroeconomic conditions of the consumer.
The aggregate is fine, but then when you look beneath that, there's like the jaws of a crocodile.
Really, the labor market's not that strong. We think that these numbers are being overstated by something like 60,000 per month.
I don't think the data is going to basically support any rate cuts, at least for the near term.
They should not get overly excited about a month or two of very strong data.
The Fed probably won't see the need to do too much more.
It's time now for our chart of the week. The two-year yield has now come down to the lowest in September of 2022. This follows the 1-2 punch of stronger job growth in January and cooler/inline consumer inflation. There's been a continued rally in the two-year note, although pretty tight range, as you can see here over the last couple of months. And the two-year, of course, the most sensitive to Fed policy. Higher price means lower yield. You've got to go all the way back to September of 2022 to see a lower yield. Now, stronger data aside, Federal Reserve Governor Stephen Miron is laying out his case for lower interest rates.
Going forward, I think there's a series of supply-driven changes in the economy that are going to be supporting economic growth. Right? It's still slack in the economy, increased potential output that can be accommodated by looser monetary policy. And so the combination of these things leads me to think that monetary policy is tighter than it needs to be, and that we can afford to have lower interest rates. The biggest risk, I think, to the economy is that we're misconstruing just how tight monetary policy is.
Stephen Miron doing his thing, remarkably consistent in calling for lower interest rates. So let's dig into all of this with our macro roundtable. Kathy Jones, Chief Fixed Income Strategist at the Schwab Center for Financial Research, and Alexander Wolf, Global Head of Macro and Fixed Income Strategy at JPMorgan Private Bank. Guys, thank you so much for joining us today.
Thanks for having us.
So the CPI report showed inflation remains relatively contained. The headline and core were either slightly cooler or in line with estimates on a year-over-year basis. Both headline and core moderated. Kathy, let me start with you. Bond yields fell. What level of comfort does this give the Fed, which under the future Federal Reserve Chair will be inclined to cut rates? How much comfort does it give the Fed?
Well, I think it helps, but core services are still sort of what's pushing up inflation under the surface. And of course, the Fed doesn't look at CPI, they look at PCE, and we'll be getting those numbers fairly soon again. So I think it's encouraging, but I don't think it's enough to shift the narrative at the Fed. So you still have relatively strong economy, you have fiscal stimulus in process from the tax changes, and inflation is still well above the 2% target. So from that point of view, I don't know that the Fed has a real impetus to do anything.
Alex, traders are starting to price in a third rate cut, now 50% odds of a third rate cut by December. Does that sound appropriate to you?
No, in our view, it doesn't. We wouldn't expect 3. We're still in line with 1. I think, as we heard in the intro, it's hard to balance 1 month of an inflation print, especially January tends to be a very noisy month. We have a lot of seasonality in the inflation print in January, which of course they try to correct for, but they can't completely correct for it. And then when we saw the jobs numbers come in, you're having a mixed picture, but you're seeing some underlying strength, or at least troughing and improvement in the labor market, which would point to needing less cuts. Mm-hmm. And so we're still in line with 1. We think perhaps the action that we're seeing today is a bit of an overreaction to 1 month of an inflation print.
Right, and in fact, this actually came up in the comments from others that there's a seasonal pattern in data where we tend to see the year, jobs start the year strong, and then it kind of fades. Do you think that's been discounted already?
Well, the jobs data, if you look at the especially the private sector job creation. A lot of it was healthcare, some education, but it is still very skewed to healthcare. Now there's some seasonality there. Of course they correct, but they can't completely correct, and that's why we see revisions. So of course we could certainly see revisions. I think the fact that it did surprise so much on the upside was a positive signal. But the January data, you do just get a lot of seasonalities. And even as Kathy said around services, especially core services, that's where you tend to see the most seasonality in CPI. And so it's hard to make really a big judgment call off of January data.
All right, and what we've seen is the steepening of the yield curve, Kathy. That's kind of been the path of least resistance. You say that another path of least resistance is a lower dollar, and that kind of goes hand in hand with it. Talk us through how you see this all playing out.
Yeah, so the dollar has been down, has been falling over the last year or so after a decade-long rally. But what we're seeing is this diversification away from the U.S. And I don't buy the, debasement trade.
Sell America, all that.
No. But I think that for a variety of reasons, what you're seeing is investors writ large start to move into other markets that are doing better and have more potential to do better. You look at emerging markets, it's a really good environment for them when the dollar is coming down, the Fed is easing, the global economy is growing, and I think investors are finding other opportunities. Also with the dollar, we have a bunch of challenges at the policy level. It seems as if the president is all in favor of a weaker dollar, and that sends a certain signal to the market that there's not going to be much to get in the way of that. So along with all the geopolitical risks, it just opens the door to a softer dollar.
And Alex, you call this buy more world rather than sell America.
Yeah, we're not yet seeing outflows. We're not seeing outflows out of the U.S. We're not seeing outflows from fund flow data or anything like that. But you are seeing a pickup into kind of ex-U.S. flows. So whether it's kind of the marginal investment dollar going into Europe, Japan, and emerging markets, that has picked up. The dollar question is a very interesting one at the moment, in that fundamentals, rates differentials would point to a firmer dollar from where we are now. We did see a bout of it disconnecting from fundamentals after Liberation Day. The dollar was weaker than models would otherwise expect, and we're seeing the same thing right now. It was relatively short-lived after Liberation Day, and then it did return more to where a model would suggest it being. And so I think the question right now is, are we seeing a fundamental shift in terms of how global investors allocate? And are we seeing some of the Greenland tensions last and persist longer in terms of positioning in the dollar, or will it return to fundamentals, which would point to a firmer, or at least let's say a range-bound dollar versus a weaker dollar from here?
When you look at treasuries, at least for this week, they traded like a clean haven. I mean, people were scared, and then they moved into treasuries. The 30-year auction was about as good as it gets, with end user demand standing out, and that reinforced the bid for duration, even as there are questions about the growth backdrop. Kathy, do auctions matter again as a tell on sentiment?
I think certainly a 30-year auction is notable because we don't get that many, and the fact that it was well bid was really an interesting signal that there are people looking for duration. There are people still viewing the U.S. Treasury market as a safe haven, I think, in a world that's tumultuous. And I do think that after the whole tariff business has died down, we had all that uncertainty to deal with for quite some time. Now it seems to be dying down again, and that probably encouraged some of the buying as well.
Alex, what do you think?
Yeah, there's a lot of interesting factors at play. I think you still have a world where there's a shortage of safe haven assets. And two, when we just got China's Q4 current account print, and we see record current account surpluses around the world, especially in East Asia. That has to be recycled somewhere, unless they want their currencies to appreciate, and they don't, as we're seeing. So that has to be recycled somewhere. It's not necessarily going to go into the 30-year, but there's definitely still a bid for treasuries, even amid all of the talk and concern around fiscal deficit and policy uncertainty, just given the imbalances that we're seeing in these very large trade surpluses that we're seeing.
Even with the reports that China's instructing its banks, for instance, not to load up on treasuries, maybe pull back a little bit, is that something you see taking shape in 2026 or something more like 2028 to 2029?
Yeah, I thought that was sort of an interesting comment, because we haven't seen from the data, at least that they release, a huge movement one way or another, that they've loaded up on them and being told not to load up on them. So I'm a little confused as to why that came out. I wonder if that isn't just more political signaling than anything else, but it doesn't seem to square up with the information that we have.
Some of it's definitely signaling. I think anytime there's an announcement like that, there's definitely a signaling intention. I think when you look at the official holdings within SAFE, yes, those have been on decline, but Treasury holdings in other official institutions, especially state banks, has been pretty steady, or if anything, increasing. So it's hard to say exactly what to take from that, but they haven't shied away from treasuries as much as I think the headlines would suggest.
Got it. All right. Kathy Jones of Schwab and Alex Wolf of JPMorgan, you're both sticking with us because still ahead, we're going to step into charted territory with our very own Mike McKee. More coming up on Real Yield right here on Bloomberg. I'm Scarlett Fu. This is the 1 hour long edition of Bloomberg Real Yield. So now that we have more time, we're going to step into charted territory where we highlight the most interesting chart of the week. And we enlisted our Michael McKee, our international economics and policy correspondent, to do the task for us. And Mike, you've got a good one for us today.
Yeah, well, this is a fun one. I thought we'd have some fun on Friday the 13th because we haven't had a lot of fun lately with the news that's been going on. I took a look at what happens on Friday the 13th in the stock and bond markets, and I went back for the last 13 years, of course. And what you see is that the bond markets tend to react quite a bit. That's the 2-year, 10-year spread in the bar graph. And you can see the spread widens and it tightens quite a bit on Friday the 13th.
Dramatic
the
moves.
Stock markets, that's the S&P 500 in the light blue there, they don't move a whole lot. Now, obviously, in 2020, there was one Friday the 13th in May that basically the markets all reacted tremendously, but we normally throw out 2020 chart data anyway. So if you want something to hold on to, you can hope that maybe we see an improvement at the close, but as you can see, the last couple of Friday the 13th haven't been all that great. No real movement in the bond market, but then you don't make any profits if you're not trading.
Absolutely. And what was the title of that chart? I can't even pronounce it.
Triskaidekaphobia, irrational fear of Friday the 13th.
Well, you could kind of expand that to irrational fear of lots of things these days, irrational fear of AI, because that's certainly what we're seeing in the markets these days. Do you look at technical factors, Kathy and Alex, when you're looking at how the bond market or the equity market are responding, especially at the end of a week that's been pretty tumultuous?
Yeah, I mean, I follow technicals pretty closely. I'm not a technician, but it tells me a lot about sentiment. It tells me a lot. I try to understand where the trend is, and then if there's a divergence from the trend, right? So sometimes I'll think the market should be going one direction, it's going the other direction, and it makes me sit up and take notice and say, what am I getting wrong?
Alex?
We don't focus on technicals as much. I think much more on the fundamentals and underlying data. Do look at flow data, flows and positioning data to the extent that that can help us tell a trend. And correlation data, but not so much in terms of technicals and moving average. It's a bit too short term for how we're thinking about.
Well, Michael McKee is staying late for us, and we appreciate that because he's been here since early this morning. He had to break down the CPI report. Was there anything that stood out to you in the CPI report today? I know when it comes to the jobs report, that was delayed from the previous week. There was a lot of talk about how it's healthcare jobs that really drove everything, all the job gains. What stood out to you in the CPI data?
Well, the fact that tariffs have started to come into the CPI data more than people anticipate. We had a big drop in services, in goods prices. They were basically flat because gasoline prices went down 3.2%. But appliances were up, furniture was up, electronics was up, all by more than a percentage point, in some cases with electronics 3% in 1 month. So we did see companies starting to pass along the tariffs. Now the question is this going to spread to more people? Are we going to see this continue? Or is this the one-off thing that Fed officials like Chris Waller have been talking about? It is something to keep in mind. Also, used cars went down in January, but the wholesale numbers suggest that they're going to be going back up in coming months. So we're not necessarily out of the inflation woods, and people who rushed to bet on more Fed rate cuts might have been a little hasty.
Yeah, Citigroup's rates trading desk says that the market is reluctant to price more inflation risk because, or in large part because, there hasn't been this rapid pass-through following the implementation of tariffs last year. Alex, do you think the market is underpricing inflation risk?
No, we don't think so. I think there definitely are some categories that we haven't seen full pass-through, and the way that we saw pass-through of these tariffs was different from the previous trade war with just China in 2017 and 2018, where there was much more direct consumer pass-through. So this, you saw it absorbed across the whole channel. Some by the exporters, very little, but some. You can see in the data quite a bit in terms of corporate margins, and then the remainder to the consumer, whereas previously it was almost directly to the consumer in a much larger share. So when we measure it, we think that we've seen most of the categories pass through to consumer by year end. We certainly did see a jump in goods last year that accounts for most of the tariffs. Of course, not all, so there will be some delay in terms of the pass-through that we'll see in the first couple of months before we probably see the full pass-through to the consumer. But we don't think it's necessarily going to upset the inflation view overall.
Gotcha. It goes to show that it really is worthwhile to take a deeper dive into the data, because the headline numbers, however encouraging they might be, don't always tell the story. Mike, the BLS is responsible for releasing both the jobs report and CPI data. We know the president fired the head of the BLS because he didn't like the data, or he didn't like the revisions to the data, and we still don't have a permanent replacement. There's been a nominee, but there's a whole process for the confirmation. Is there reason to question the veracity of the data because there's no one in charge at the BLS right now?
No, actually, that almost has nothing to do with it, because the commissioner of the BLS does not see any of the data until it is already finished and put out. And what they do, and particularly with the jobs report, there's so much data in there, they produce them in silos, and then they're put together at the end of the process. So nobody really has access except the people who are directly working on it, and those are still all of the dedicated, long-time public employees at the BLS. So there's no reason at this point to think that anything is being in any way manipulated. The only thing you have to worry about is do they have enough money to collect the data effectively? That's a whole other argument, but it is an issue.
Do you worry about that, Kathy?
Oh, I worry about the integrity of the data these days, simply because of the cutbacks between the personnel and the amount of money to conduct the surveys and get out there and do things. We know that they've cut back. We know that they've cut back both in the employment numbers and in the inflation numbers. And we can't make good decisions without good data. So it is a troubling aspect of this.
How about you, Alex?
It's not something we spend a lot of time worrying about, I think, but as Kathy said, the sheer cutbacks we've seen in the jobs numbers in the government, it's hard to know exactly, like in the data it breaks out how much was Defense Department or Department of War, as it is now called. But the other departments, it's not broken out, so I don't know if it was Bureau of Labor Statistics or Census Bureau. It's hard to say.
I'm Scarlett Fu. This is the 1 hour-long edition of Bloomberg Real Yield. So now that we have more time, we're going to step into charted territory, where we highlight the most interesting chart of the week. And we enlisted our Michael McKee, our international economics and policy correspondent, to do the task for us. And Mike, you've got a good one for us today.
Yeah, well, this is a fun one. I thought we'd have some fun on Friday the 13th because we haven't had a lot of fun lately with the news that's been going on. I took a look at what happens on Friday the 13th in the stock and bond markets, and I went back for the last 13 years, of course. And what you see is that the bond markets tend to react quite a bit. That's the 2-year, 10-year spread in the bar graph. And you can see the spread widens and it tightens quite a bit on Friday the 13th. The stock markets, that's the S&P 500 in the light blue there, they don't move a whole lot. Now, obviously, in 2020, there was one Friday the 13th in May that basically the markets all reacted tremendously, but we normally throw out 2020 chart data anyway. So if you want something to hold on to, you can hope that maybe we see an improvement at the close, but as you can see, the last couple of Friday the 13th haven't been all that great. No real movement in the bond market, but then you don't make any profits if you're not trading.
Absolutely. And what was the title of that chart? I can't even pronounce it.
Triskaidekaphobia, irrational fear of Friday the 13th.
Well, you could kind of expand that to irrational fear of lots of things these days, irrational fear of AI, because that's certainly what we're seeing in the markets these days. Do you look at technical factors, Kathy and Alex, when you're looking at how the bond market or the equity market are responding, especially at the end of a week that's been pretty tumultuous?
Yeah, I mean, I follow technicals pretty closely. I'm not a technician, but it tells me a lot about sentiment. It tells me a lot. I try to understand where the trend is, and then if there's a divergence from the trend, right? So sometimes I'll think the market should be going one direction, it's going the other direction, and it makes me sit up and take notice and say, what am I getting wrong?
Alex?
We don't focus on technicals as much. I think much more on the fundamentals and underlying data. Do look at flow data, flows and positioning data to the extent that that can help us tell a trend, and correlation data, but not so much in terms of technicals and moving average. It's a bit too short term for how we're thinking about.
Well, Michael McKee is staying late for us, and we appreciate that because he's been here since early this morning. He had to break down the CPI report. Was there anything that stood out to you in the CPI report today? I know when it comes to the jobs report, that was delayed from the previous week. There was a lot of talk about how it's healthcare jobs that really drove everything, all the job gains. What stood out to you in the CPI data?
Well, the fact that tariffs have started to come into the CPI data more than people anticipate. We had a big drop in services, in goods prices. They were basically flat because gasoline prices went down 3.2%. But appliances were up, furniture was up, electronics was up, all by more than a percentage point, in some cases with electronics 3%. In 1 month. So we did see companies starting to pass along the tariffs. Now the question is this going to spread to more people? Are we going to see this continue? Or is this the one-off thing that Fed officials like Chris Waller have been talking about? It is something to keep in mind. Also, used cars went down in January, but the wholesale numbers suggest that they're going to be going back up in coming months. So we're not necessarily out of the inflation woods, and people who rushed to bet on more Fed rate cuts might have been a little hasty.
Yeah, Citigroup's rates trading desk says that the market is reluctant to price more inflation risk because, or in large part because, there hasn't been this rapid pass-through following the implementation of tariffs last year. Alex, do you think the market is underpricing inflation risk?
No, we don't think so. I think there definitely are some categories that we haven't seen full pass-through, and the way that we saw pass-through of these tariffs was different from the previous trade war with just China in 2017 and 2018, where there was much more direct consumer pass-through. So this, you saw it absorbed across the whole channel. Some by the exporters, very little, but some. You can see in the data quite a bit in terms of corporate margins, and then the remainder to the consumer, whereas previously it was almost directly to the consumer in a much larger share. So when we measure it, we think that we've seen most of the categories pass through to consumer by year end. We certainly did see a jump in goods last year that accounts for most of the tariffs. Of course, not all. So there will be some delay in terms of the pass-through that we'll see in the first couple of months before we probably see the full pass-through to the consumer. But we don't think it's necessarily going to upset the inflation view overall.
Gotcha. It goes to show that it really is worthwhile to take a deeper dive into the data because the headline numbers, however encouraging they might be, don't always tell the story. Mike, the BLS is responsible for releasing both the jobs report and CPI data. We know the president fired the head of the BLS because he didn't like the data or he didn't like the revisions to the data, and we still don't have a permanent replacement. There's been a nominee, but there's a whole process for the confirmation. Is there reason to question the veracity of the data because there's no one in charge at the BLS right now?
No, actually, that almost has nothing to do with it because the commissioner of the BLS does not see any of the data until it is already finished and put out. And what they do, and particularly with the jobs report, there's so much data in there, they produce them in silos and then they're put together at the end of the process. So nobody really has access except the people who are directly working on it. And those are still all of the dedicated, long-time public employees at the BLS. So there's no reason at this point to think that anything is being in any way manipulated. The only thing you have to worry about is do they have enough money to collect the data effectively? That's a whole other argument, but it is an issue.
Do you worry about that, Kathy?
Oh, I worry about the integrity of the data these days simply because of the cutbacks between the personnel and the amount of money to conduct the surveys and get out there and do things. We know that they've cut back. We know that they've cut back both in the employment numbers and in the inflation numbers. And we can't make good decisions without good data. So it is a troubling aspect of this.
How about you, Alex?
It's not something we spend a lot of time worrying about, I think, but as Kathy said, the sheer cutbacks we've seen in the jobs numbers in the government, it's hard to know exactly, like in the data it breaks out how much was Defense Department or Department of War as it is now called. But the other departments, it's not broken out, so I don't know if it was Bureau of Labor Statistics or Census Bureau. It's hard to say.
All right. I really appreciate both of you sticking around. Kathy Jones of the Schwab Center for Financial Research, Alex Wolf of JPMorgan Private Bank, and our very own Michael McKee, our international economics and policy correspondent, with our chart of the week. All right. Coming up next, global return. This week, we saw a high volume of U.S. companies like Alphabet and Goldman Sachs holding debt sales in Europe. We're going to talk reverse Yankee bond sales next. This is Real Yield on Bloomberg.
I'm Norma Linda. Let's take a look at your midday movers. First up, the artificial intelligence scare trade is receding today, with several stocks caught in the crosshairs earlier this week, rebounding this afternoon. Shares of real estate services companies CBRE and JLL are rising alongside logistics firm C.H. Robinson. Meanwhile, dip buyers are rushing in to snap up Bitcoin, Ethereum, and other crypto-related assets as investors hunt for signs the market may be bottoming out. And digging deeper into those individual names, Coinbase, Circle, and Robinhood are among some of the names drawing attention this afternoon. Those are your midday movers. I'm Nora Melinda.
It's time now for Global Return, where we highlight stories outside the U.S. A rush of reverse Yankee debt sales hit the European primary market, matching a trend that we saw last year. These types of deals are when U.S. companies raise money in non-dollar markets. For more on this, let's cross over to Ronan Martin. He is covering credit and IG bonds for Bloomberg News in London. Ronan, good to speak with you. So, I mean, we know about Alphabet and its big bond sales overseas, but we're talking about financials, Goldman Sachs and JPMorgan as well. Just give us a sense of the scale of what we're seeing with these reverse Yankee bond sales.
Yeah, so there's a real rush of issuance this week. Obviously, as you mentioned, Alphabet earlier in the week with that 5.5 billion sterling deal, and kind of that record number doesn't even include the Swiss franc deal. That's a kind of separate set of numbers. But that was followed by Goldman Sachs, JPMorgan, Ford and others coming later in the week. And Goldman did what is one of the kind of largest ever euro-denominated financial bond sales at 7 billion. A huge deal. And then all of these deals have had really, really strong demand across all the tranches. However, this trend, it was building on kind of what we've seen earlier in the year. IBM came earlier in the year and was one of the bonds kicking off the kind of the big tech bond sale. I think I came on the show to talk about that earlier in the year. But it's something we've seen where US companies want to diversify away from dollar markets, where they're doing so much funding already, and there's a risk that if you do too much funding in any singular market, particularly your home market dollars, it can push out your spread curves and kind of really raise your borrowing costs. So these international companies, particularly the ones that have, maybe even particularly ones that have European operations, you can raise dollars over here, raise euros over here, and kind of broaden your funding base, diversify your kind of investors, and get some kind of good quality deals.
Get good quality deals. Do you end up paying less? I mean, for the companies, is it worth it? Is it cheaper?
So that's a bit of a debate. You kind of US dollar yields are sitting around kind of 4.8%, I think, at the moment, and then euro denominated is around 3%. So that kind of headline coupon is going to be cheaper for them, and it kind of depends what the company does with it. If they're swapping them back, there's some debate about how it lines up when you convert back to dollars. But I think a lot of them do end up keeping it in euros. But from my chats with syndicate managers, a lot of the time this isn't about the kind of headline currency figure. It's about kind of the pools of liquidity elsewhere and kind of tapping some of these other markets.
Yeah. So what kinds of investors do they gain access to by selling these bonds overseas?
There's a whole wide European investor base. You've got European insurance, pension funds, large European asset manager community. There's kind of all sorts to tap into over here. So it's obviously not as deep as the dollar market, which is famously the most liquid market.
Sure.
But don't look down on euros. It is a big market.
All right, good stuff. Ronan Martin joining us from London. Thank you so much. Coming up next on The Real Yield, the auction block. This is Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the auction block, where we highlight this week's global credit issuance. Here in the U.S., high-grade sales topped $40 billion, matching the estimate for the week. Alphabet's $20 billion sale accounted for half of the total. You also had names like Disney and Royal Caribbean issuing debt. Now, as we highlighted a moment ago, Alphabet was also the big name in Europe this week. It sold sterling and Swiss franc offerings, both of which were the biggest ever corporate sales in their respective markets. The sterling issue included an ultra-rare 100-year note. And over in high yield, orders are surging for a $3.8 billion junk bond sale from Tract Capital. This sale is tied to a data center expected to be leased by NVIDIA. Orders hit about $14 billion as of this morning. The deal was also upsized and the yield was lowered. Aaron Weinman with Bloomberg News has been covering the story, and he joins us now. So, Aaron, this sale was just priced, wasn't it?
Yes, it did just price at the terms that we reported earlier, so tight to the initial talk. And as you mentioned, the orders for the bond did go above $14 billion, if I'm not mistaken.
Okay, so NVIDIA itself has not issued any debt since its AI boom began in early 2023. I was checking the last time it did, it was somewhere in 2021. And it's still not tapping the debt market directly, but there is a linkage here to Tract Capital. Tell us who Tract Capital is, what it does.
Yeah, so that's a good question. It's interesting because they are effectively, they're an asset manager, but what they've done is they've set up, I guess for lack of a better word, this fund that I believe is called Fleet. And this is being used to build data centers, which is, in this case, being leased to NVIDIA.
And this is a junk bond, too, as well. In terms of Tract marketing this debt, how much does NVIDIA's name show up? Or is that something just everyone knows?
I mean, in the marketing documents, it does pop up quite often.
Okay, so it's
very
prominent.
Clear. Yes, very much so, that they are the entity leasing the facility.
And this is not the first time that you've had some big tech name go through other companies to issue debt, right? I mean, Alphabet did something similar.
Do you mean in terms of high yield bond issuance? Mm-hmm. Yes, that's right. So there were two issuers last year. They were actually both crypto mining companies, one named TeraWolf, the other named Cypher. And they both had these novel, they called them wraps, that were basically provided by Google. And if the data centers were not constructed, then Google would step in and protect the bondholders effectively.
All right, good stuff. Thank you so much, Aaron Weinman, with the latest on this junk bond debt sale from Tract with NVIDIA involved. All right, we're going to stick with credit because the spending spree to fuel this AI arms race is disrupting everything from public to private debt.
You go from software to insurance brokers to asset managers to media to logistics, and you're basically re-underwriting cash flows on all these sectors for the next 20 years. And at some point, and this is what would disrupt the issuance, is that you might see risk premiums widened out so much that you won't be able to come to market because the investors will be on their heels and very cautious. At that point, you're going to see issuance really slow down.
So let's dig into all of this with our credit roundtable. Jerry Cudzil is Generalist Portfolio Manager for Fixed Income at TCW, so he knows Brian Willen well. And Matt Brill is Head of North American Investment Grade Credit at Invesco. So Matt, let me start with you. Do you agree with Brian Willen that issuance could start to slow down in a meaningful way because of this rolling AI scare?
Well, I don't think we're really going to slow. So I think the demand may pause a little bit, but the supply is going to keep coming. So we're seeing companies setting record pace to start the year. You had over $200 billion in January. You've already had over $100 billion in February. So we're probably going to hit close to $2 trillion on the year. And there's a lot of disruption going on. We kind of went from fear of missing out to fear of disruption overnight. Mm-hmm. And so right now, I think there's a little bit of a pause from demand, but I think companies are going to keep issuing.
Well, right now, that's certainly what we're seeing. I guess down the road is the question. Jerry, the AI scare combined with the massive issuance that we've seen so far means we're already seeing credit spreads start to widen out. The widening is not massive, but it is notable. It is there. So how much do you read into that? What does that signal to you?
Well, I think if you take a step back, Scarlett, I think that you're not at the broadest level, at the index level, you're not seeing a widening out. What you are seeing is a real big dispersion take place. And you'll see that in a couple of areas. One, in the leveraged loan market, where you see a very concentrated, high portion of the loan market trade above par. And then you see this kind of growing tail of companies in software or even insurance broker or asset manager. And those companies are actually experiencing real significant price declines, and those are starting to break apart. So I think there's a real dispersion that's taking place. At the index level, you really have to kind of squint to see any kind of real widening. And I think it's a good point. I think the issuance is going to come as long as the markets remain open. I don't think it's a function of necessarily 5 or 10 or even 20 basis points. And that's why we, in our base case, think you're going to see some pressure on corporate spreads as we move through the year.
All right, I'm glad that we have this chart right up because it used to be that investors would have to pay up to buy tech bonds. Now, for the first time since the financial crisis, you get a discount for buying tech bonds. Is this more a result of increased supply, Jerry, or does it tell us something about demand faltering?
Well, I think it's a little bit of both. I think it was really interesting because if you kind of rewind the clock 18 months, we kind of said to ourselves, okay, hey, this is not going to be the telco boom of 01 or 2000 because you have hyperscalers who generate significant cash flow, and all of this CapEx is funded out of cash flow. And you've seen a real significant change of pace in debt issuance and structures and high yield bonds, and you're financing everything from power supply agreements to chips. So as we see the evolution here, we would say there's a structural increase in supply for sure. And there's a weakening of the balance sheet. Now, I don't think there's any of these companies are necessarily at risk here, but there is a weakening of the balance sheet. So I think it's a combination of both. I don't think you can ignore it.
So referencing that chart once again, Matt, do you think that's a temporary widening or the start of maybe a regime change?
I think it is a little bit of a start of a new regime change. So you've seen a lot of issuance out of the tech companies, but it's just not about the dollars. It's also where they're issuing. And so a front end of the issuance is actually doing quite well. You take Google, for example, they issued, I think, at 27 basis points for the 3 years. So very tight spread. And now it's trading at 20 basis points over. So there's been a lot of demand for the front end because people know that that's money good. Out the curve, the quality is there, but there's just a lot of weight to it. So there was about 40% of the Google and the Oracle deal that were issued 20 years and longer. And that's very rare. Normally, you're getting these short bonds or spread across the curve. And then Google, obviously, we've been talking about it all week, that they issued 100-year over in sterling. So there's just a lot of weight. And those, they're not the same dollar weight for a 100-year as a 2-year or a 3-year. It just puts a lot more spread duration in your portfolio, makes it a lot whippier. And so in that regard, I think you have to get paid more. And the more they want to issue out the curve, I do think the more pressure it's going to put on spreads, particularly within tech.
Would you consider, Matt, taking on a 100-year risk from a tech company, even a tech company like Alphabet? I mean, we know insurance companies want the duration to match their liabilities.
I love the 100 years. I love the 60 years. Only if you get paid, though. You have to get paid. It has to be a steep curve. If you're getting enough of a curve, enough of a pickup to it, it makes sense. And the reason why is because these are liquid bonds. You're getting paid a lot more, and you can sell them if things change. You really can't forecast a 30-year tech bond anyway. I have no idea what's going to happen in Google in the next month, let alone 5 years or 30 years. But in the instance of the UK sterling bond for Google, it was a 60 basis point spread pickup, but uniquely enough, it was only a 10 basis point yield pickup because the 30-50 gilt curve is heavily inverted because of all the demand from pension plans in the UK. So it's just a really unique thing. But in my opinion, I don't mind it at all because I can sell it, but I got to get paid for it.
Jerry, what do you think? Would you be a buyer of the 100-year Google bond or Alphabet bond?
I think you have to get paid. I don't think the curves are steep enough. I think you rewind 3 years. It was on nobody's whiteboard to have $3 trillion of AI CapEx spend. I think the pace of technological change and the risk of obsolescence is pretty significant, and I think the curves have to be a lot steeper. And so our view is that you're not getting paid to kind of move out the curve. So no, not right now. I think there's room in portfolios depending upon goals of different portfolios for different assets. I would never say we wouldn't do that, but I would just say I think Matt's point's the right one, which is you need to be compensated in a world where issuance is going to be structurally higher. You're going to have options to add duration to your portfolio, given the needs and the amount of supply that needs to come and all the markets that need to be tapped. So I don't think you need to necessarily reach to buy a 100-year bond at this point. There's a lot of options.
There are a lot of options. And I'm sure, Matt, that you must be a big buyer of tech debt because of all that's coming to market. Are you happy that there's going to be more tech than bank credit being issued? I mean, is that a good thing for you?
So it gives us another thing to look at. So obviously in the past, you had kind of a very consistent fastball being thrown at you from the banks. Every quarter you got what you knew what you're going to get. And now we're wondering, is that what you're going to get from the tech companies? Or are there going to be a lot of curveballs thrown at you with a $50 billion deal followed by the next quarter with a $10 billion deal? We don't really know. But if you can get the consistency of it, I think it could actually be pretty good because you are getting really high quality companies. And one of the things I want to point out about Oracle is that they did issue $20 billion of equity, at least we think. They told us they're going to. And they did do $5 billion of preferred that we know they did. So they are willing to defend their balance sheets if they have to, which is key because I'm not worried about Google, but I might be a little bit more worried about Oracle. And if they're defending their balance sheet like they did, that's a really good positive.
That's a good sign for you. Jerry, how do you manage concentration risk with all this tech credit coming out?
I think you have to manage concentration risk across sectors at this point. I think you have to be very careful or very measured and purposeful about your risk because these securities are being accessed in the dollar market, in the euro market, in the asset-based finance market, in the CMBS market, and I think you could quickly compound your risk. And so our thought is it's not just managing your ticker exposure or sector exposure within your corporate credit, because actually in portfolios now you could take on risk in a number of different ways in these segments, and this CapEx is so big. And it's so daunting that you're going to be tapping every market from public to private, from ABS to CMBS to corporate credit, and it's going to be really broad. And our thought is that it's going to be structural. And so just like banks were structural, 3-4 years ago, and they traded wide to the index because of structural supply. Our view is that in tech, you're going to have that same exact situation where you're going to have a structural supply headwind for tech, and you're probably not going to see the spreads that you saw at least for a few years as supply gets absorbed. But we think it'll be a few years before you see a full remediation in spreads.
As we take a step back and consider what's going to happen in 2026 under a new Fed chair, Kevin Warsh, once he's confirmed, if he is confirmed, will there be a Fed put, Matt? Kevin Warsh's history shows that he's very focused on winding down the balance sheet.
I think there is still the Fed put, and I think even the employment data you saw this week was pretty good. But then the CPI today, it's like, okay, that puts the Fed put back in play because you're not overly concerned about inflation. If you get the inflation, demon picking back up again, and everybody has to be worried about it, yes, that takes that put off. But I think the Fed, what you saw from Powell's, when they actually bought corporate credit and around COVID, there was always that Fed put to credit, but it was also there for the equity market. And at the end of the day, the administration has acknowledged that they talk about the stock market all the time. So if the stock market's going down, they're going to be making sure that there is some sort of put there.
Do you think under a Fed chair, Kevin Warsh, Jerry, that there's going to be a Fed put for credit?
I think Warsh is going to be very measured about what he does with the balance sheet. He's been very clear that the Fed inserting itself into the market during periods of volatility and stress are critical, a buyer of last resort. But I think what Warsh has been critical of is that the balance sheet has kind of stuck around too high for too long. And I think that'll be the key. And as long as the financial plumbing is intact, which I think is what Warsh and what the Fed is really going to be focused on, then our view is that you won't see the Fed involved in the markets. In terms of the put, our view is that the Fed has to get to neutral first. The Fed is already restrictive. They have to get themselves to neutral under a kind of a Warsh Fed. Our view is they will get to neutral by the end of this year. That will be 3 cuts. Inflation is allowing them to do that. So our view is that you'll see a neutral Fed funds rate by the end of this year.
Right.
It'll be fairly supportive for the markets as the inflation and the tailwind give them the ability to wind down their balance sheet.
All right, one thing at a time, right? Jerry Cudzil of TCW and Matt Brill of Invesco, thank you both so much. And if you want more talk on credit, please check out the Bloomberg Credit Edge weekly podcast on the terminal. It features all my colleagues at the top of their game. Be sure to check it out wherever you get your podcasts. Still ahead, a moment of interest. AI disruption fears rattling private credit. This is Bloomberg Real Yield.
Happy Friday. We're about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at our midday movers. First up, Applied Materials shares are climbing to a record after the company delivered a surprisingly upbeat sales forecast. This signaling that demand for artificial intelligence and memory semiconductors is fueling equipment purchases. Also, shares of Arista Networks are rising after its forecast for fourth quarter revenue topped the average analyst estimate. Several Wall Street analysts hiked their price targets and are positive about AI networking demand momentum. And finally, Rivian is leaping for double-digit returns after it reported better than expected fourth quarter metrics and its first ever annual gross profit, a key milestone after years of consistent losses. Rivian expects to deliver between 62,000 and 67,000 vehicles this year. Those are your midday movers. I'm Nora Melinda.
It is time now for a new segment called Of Interest, where a story of interest catches our attention this week. The software sector has been hit really hard due to worries about AI disruption. Holden Spott of Thoma Bravo, one of the world's biggest software-focused investment firms, spoke to Bloomberg Deals and was seeking to reassure investors on the sector. Here's what he told Danny Berger.
All of our software companies are using AI, they're selling AI, they're developing AI. AI is software. Software is AI, if you do it right. So to think that all software is the same, we think is, they're missing the mark a bit. We think this could be a really exceptional buying opportunity.
To think that all software is the same is missing the mark a bit. So, sometimes you can take that to an extreme because a Bloomberg investigation found that hundreds of investments that are seen as software companies are actually being labeled otherwise by lenders. And that raises questions over just how much exposure private credit has to software at large. Bloomberg's Olivia Fishlow joins us now to tell us more. Can you give me an example of what you mean by this?
Yeah, definitely. So basically, to break it down, these private credit firms have funds where they label their investments by industry. And so we check to see were the software investments labeled software like throughout every fund. And in some cases, for example, one company that was labeled software by one fund was labeled food as another fund.
How can they justify that, or what's their explanation?
Yeah, so what they say is that they classify these investments by end market. So that food one does provide software to restaurants, for example. But still another company will look at that and say it's software. So it definitely is interesting.
Okay, so is there anyone overseeing this? Do regulators have a say in any of this? Did you reach out to regulators?
So we did reach out to the SEC for comment. They declined to comment for the story. But the funds that we looked at are 40 Act vehicles. So it's very much to the manager of the fund to make those distinctions. And I think that's sort of why investors are looking at these funds and saying, do I trust this manager, and are they truly being transparent?
Right. I mean, just how much software does this fund actually have? And depending on what the answer is, that will affect the valuation of the portfolio as well. Are these portfolios currently valued at about where they need to be then?
I think what we've heard so far is that these software companies and these businesses are still performing well, and most of the loans are marked at par. But I think obviously the question is, as AI continues to evolve, what happens next?
All right, Olivia Fishlow, a fantastic read here on the Bloomberg. Be sure to check it out. Private credit software bet is even bigger than it appears. Still ahead on Real Yield, we've got the final spread. It is the week ahead. More inflation data on deck. This is Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the final spread, the week ahead. Coming up on Monday, U.S. markets are closed for President's Day. On Tuesday, Asian markets are closed for the Lunar New Year. Wednesday, we get the FOMC meeting minutes, plus earnings from Carvana, Molson Coors, and more. On Thursday, earnings from Walmart and a slew of Fed speak. And on Friday, U.S. PCE data and a possible, we've been waiting for this, Supreme Court ruling on President Trump's tariffs. For my final thought, I want to bring back Bloomberg's Michael McKee to look ahead to that PCE print. And this is the inflation gauge that the Fed looks at and really keys off of.
And that's the most important thing here, because everybody today started thinking, oh, more Fed rate cuts because CPI is moving down very close to what the Fed's target is. Problem is, Fed doesn't care. It's CPI. And CPI has some troubles, of course. There was no October CPI, so the government put in 0 for the month, and that is artificially biased CPI down. The problem, and I brought along a chart because, of course, that's what I do. The problem is that PCE is likely to be going up, according to the Bloomberg consensus. The economists we surveyed think that on a year-over-year basis, we're going to end up with something over or close to 3%. You can see the red line there as the estimation. Now, this is a December number. Today's CPI was January, but you can see the impact of the government shutdown on the CPI numbers and how they have come down. But the blue line is PPI, and the yellow and red lines there are the PCE, and they're going in the wrong direction. So if we get a 3% print next Friday on PCE, best be first in line to sell those Fed fund futures estimates for the summertime.
The key line here in this chart is the green line, right at 2%, because that's what the Fed's target is.
That's the Fed's target. You can see how far away we are from that.
And I mean, not only that, we're no longer even a 2 handle if we get to that 3%. Like, this doesn't put us anywhere near 2-ish.
It doesn't put us anywhere near 2-ish, and it shows that we're going in the wrong direction. Of course, this could all change. We will get a delayed version of PCE once we get into March. It won't be at the usual time. It'll be a couple of weeks past the usual time. But the Fed is going to be on hold for a while because they're not going to see the progress they want to see.
Right.
Couple that with the jobs report, which was stronger than expected. And it's hard to make a case for a rate cut anytime soon.
What do you think we're going to get from the minutes of the January 28th FOMC meeting? Are you looking for anything to really, bring some new insight into this debate?
Not a whole lot, and the reason being is we got these jobs numbers after the Fed meeting. We're getting these inflation numbers after the Fed meeting. So the Fed speak that we're going to start getting, that you mentioned, is going to be more important because we're going to be trying to recalibrate what we think they think about the possibility of rate cuts. The problem is the Fed meeting will have been 3 weeks ago, and so the minutes are a little stale, especially since we've gotten the important data points for them after the Fed meeting.
When is the Fed's next statement of economic projections? When do they come out with their next forecast?
March 18th is the next FOMC meeting at which they put out with that and the dot plot. It'd be interesting to see how things have changed.
All right, Michael McKee, thank you so much, our international economics and policy correspondent. That does it for us here from New York. Please check in and tune in to Real Yield next week. Same time, same place. This is Bloomberg.